What I've got for you on inheritance tax is a number of questions taken from the syllabus. It's taken from the CeMAP 1 exam, which of course touches all sorts of taxation issues. Inheritance tax is one of those taxes. So I've got several questions for you. I'm going to go through them. So let's have a look, because you've already read this, haven't you, while I've been talking here. So which type of policy then is usually most appropriate to fund a future inheritance tax liability on an estate, is the question. And we've got endowment policy, family income benefit, increasing term assurance, or whole of life policy. So again, if you're in the mortgage world and you're learning this topic, you probably don't come across this too much. The policies you probably sell are family income benefit and increasing term, possibly for life protection. You won't have touched an endowment policy. They've not been around for years. They've died a death, haven't they? Whole of life policy is an interesting one, because that's a pure life cover, sometimes with investment built in, which pays out whenever you die, whenever. Now, when it comes to inheritance tax liability, you can do all sorts of things to try and reduce it, and some of our other questions will go through that with you. But ultimately, you may have to foot a bill. In other words, when you die, your estate is then put together, collated, they work out the inheritance tax liability, and your executors, or the next of kin, effectively the beneficiaries of your estate, will have to pay a load of money to HMRC. So what people can do is effect a life assurance policy to pay out when you die, pays out to the beneficiaries, who then pay the inheritance tax. And because you don't know when you're going to die, most of us don't, you know. I'm 61 now, I'm thinking, well, have I got 10 years, 5 years, 20 years? You don't know, do you? Because life just is like that. So the whole of life policy is the one you want. You don't want any of these because they've all got terms attached to them. So you effect a whole of life policy in your name, and that has a sum assured which pays to the beneficiary of your will, the next of kin, if you like, and you do it in trust, so it doesn't form part of your estate, and the money therefore goes straight to the beneficiary, and they use that money, that cash, to pay the inheritance tax bill. So that's quite a common way of handling a bill once you've done everything you can to reduce it. So that's question number one for you, which is quite a nice one, isn't it? Okay, got a few more for you. Then we're just going through some questions with you. Here we go. A potentially exempt transfer may occur or incur an IHT liability if death occurs within 3, 5, 7, 9. Typical, they go up in numbers, don't they, these questions? So what's this all about then? Well, a potentially exempt transfer. Well, whilst you're alive, and in your will, of course, you can give money away or transfer money to people, charities, political parties, whatever you want to do. And there's a number of exempt transfers. These are things that you can give away during your life or in your will, and it's exempt from inheritance tax. You know, between spouses, for example, civil partners, you can give money to each other, and that's exempt. You can give gifts away of less than £250, which is not a lot of money these days, is it? On marriage, on wedding, you can give your child £5,000. If you're a grandparent, you can give them £2,500. So that's it, like a wedding gift. There's lots of ways in which you can give to charities if you wish to. These are all exempt. In other words, they won't form part of your estate when you die because you've given the money away. However, there's this big thing called potentially exempt, which means that it's exempt, but only potentially. And it's usually something you give away during your lifetime, which you would normally be part of your estate. So you're giving, for example, I know, let's say you're giving £100,000 to your children to help them with their house purchase. £100,000 would normally form part of your estate, but if you give it to your children, the revenue think, well, hold on, you've just given it to them to try and avoid inheritance tax, so we're going to potentially exempt that. And they give it a period of 7 years. They call it a PET. So for 7 years, the whole point is that you're going to have to live for 7 years. And if you survive 7 years, it's then completely exempt, which is great. So if you're young, it's fine. But if you die within those 7 years, and there's percentages, a certain proportion of the value of that transfer will be included in your estate on death anyway, regardless. And there's the 7-year rule, which is obviously what you've been looking at there. So may incur an IHT liability if death occurs within 7 years. So if you die within 7 years, then a percentage of that gift is still added to your estate, even though you've given the money away a long time ago and you're now dead. So that's a pet. That's an interesting question. No. Okay, let's get on to the next one, shall we? Here we've got an individual dies in December 2024, just for the tax rates really, isn't it? But the inheritance tax rate hasn't changed for donkey's years. Now this person left an estate of £550,000, of which 425 is left to an old friend, £100,000 to a registered charity, and £25,000 to his political party. Well done them. What will be the inheritance tax payable? Now remember I mentioned to you about exempt transfers. You can give money away during your life or in your will, and it's exempt from inheritance tax. Well, good news is that a registered charity is exempt, and so is a political party. I think they have to have a couple of MPs, so I don't know if Reform Party count, and they have to be a proper political party, not one you just set up for the purposes of gifting money to. But anyway, you give it to whichever party you want. I don't want to get into politics. But a registered charity, you can give money away, and that is also exempt. So the only bit that's actually liable to inheritance tax is the 425,000 to an old friend. So therefore the revenue will look at 425,000 and work out the IHT bill on that one. Now, as you know, with inheritance tax, it's payable on your death effectively when it passes through probate. But there are a number of nil rate bands. There's two nil rate bands which you need to be aware of. There's the normal nil rate band that everybody has. That means you can give away or you can die with a certain value of an estate and there's no inheritance tax to pay. And the current figure for that is 325,000, which hasn't changed for a long time either. But obviously we've gone over, we're at 425. So £325,000 is the nil rate band. Above that, the estate is charged at 40%. There is also a main residence nil rate band. In other words, if the assets of the estate have a family home in there, and that's less than 2 million, then that can give you another nil rate band of 175. So you could have, if a main residence forms part of your estate and it's going to your children or grandchildren, you could have 500,000 as nil, but the rest is then 40%. So you're thinking, okay, 425,000, pretty easy, less 325,000, which is the nil rate band. So it's £100,000 is liable to inheritance tax. Now remember, these calculations in CeMAP aren't complicated. You don't need a calculator. £100,000 at 40% is £40,000, which is what most people go for. But there's a little rule here that people that they miss, which is if you give around about 10% of your money, if your estate goes to charity, which is very generous, then you can actually reduce the percentage of inheritance tax from 40 to 36%. Not a lot of people know that. So they've given £100,000, which is way over that as a proportion of the estate. So their inheritance tax bill comes down to 36%, because it does. And that therefore means that A is the correct answer, 36,000. A lot of people get that one wrong because they don't read the detail. People accuse CeMAP for trying to trick you. They don't. They just want you to really think. That's all. That's what they're trying to do. It does make you think. So, on to the next question, shall we? We're having fun here, aren't we? What is the maximum amount that each parent can give to their children, or daughter I should say, utilising the gifts and consideration of marriage exemption from inheritance tax? Kind of mentioned that, didn't I? Exempt transfers. You can give over £250 to anybody, give what you like to your spouse, to a political party, to charities. But in the event of a wedding, you can give some money away. £5,000 for a parent, and a grandparent can give £2,500 away, and anybody else can give £1,000, which is great because you're setting them up, aren't you? So that pretty much means this one's quite easy at 5,000 because it's a parent. So that's the answer, 5,000. Nice. Okay, nice easy question. Okay, let's see. Flick on to the next one then. In respect of inheritance tax, a bequest to a registered charity. There you go. Talked about this already, haven't we? I love the word, a bequest. Very Latin, isn't it? Now, is it A, full exempt, potentially exempt, subject to IHT at 20% or subject to IHT at 40%? All very good answers that make you think, don't they? 40%, you've obviously mentioned that already. The 20% lifetime transfer charge, you've read about that. Potentially exempt, we mentioned that with potentially exempt transfers, a 7-year rule, or fully exempt. Now, of course, the answer here is a registered charity is fully exempt. You can give it to a registered charity now, or in your will, and it removes that amount of money from your estate. Simple as that. Which is why around about this sort of time of year, a lot of charities are sponsoring you to have a free will done. So they get some lawyer firms who give their time for free, and they arrange your will for you for free. What's that all about? But of course, the law of reciprocity comes in. You feel obliged to leave a few grand to that charity because they paid for your solicitor to do the will for you. Very clever, isn't it? Good marketing, that. Okay, so that's a pretty straightforward one. Now, what else have we got then for you? Here we are. Mr. T, Mr. Trent, will potentially incur an inheritance tax liability if he disposes of his valuable Turner painting in which of the following ways. Okay, well, don't look at the answers yet. Mr. T is still alive, because he is, and he wants to potentially remove an inheritance tax liability if he can. So he's disposing of his valuable Turner painting, which is obviously worth a few quid. So which of these ways then will actually potentially incur an IHT liability? 3 of these won't incur IHT, 1 will. So we're looking here at exempt transfers, aren't we? So let's have a look at each one. A, he gives it to his missus, his wife, spousal transfer, perfectly acceptable for eliminating that value of that asset from his estate. Obviously, Mrs. T will have it in her estate. When she dies, she's got to pay it, isn't she? So there we are. B, he sells it to his daughter for a token amount. That's an interesting one, actually. We'll come back to that one. C, he sells it at auction when a local dealer would have paid a higher price. Okay, so he's put it at auction when a local dealer would have paid a higher price. So is that potentially incurring an IHT liability? A, he leaves it in his will to a historic house owned by the National Trust. So that's again an exempt transfer. Giving your items to be displayed in public also exempts you from it. So we've got 2 here then. Selling it to his daughter for a total amount, selling it at auction when a local dealer would have paid a higher price. Now, which is the correct answer? Which of those will potentially incur an IHT liability? Well, look at C then. If he sells it at auction when a local dealer would have paid a higher price, okay, that's his shout, isn't it? But if he sells it at auction at a couple of £1,000, and he could have got a better price by going into a local dealer's antique shop, that's his business choice. Obviously, he sells it, so he's made money, he's made cash, and he's put that cash in the bank. So effectively, his estate hasn't really gone down in value, has it? So that actually won't actually achieve anything. But B will. If he gives it to his daughter for a total amount, that was £1, he's not made any money from it, but he's effectively given it to his daughter to keep. The point here, though, is that the capital people, the HMRC, if they get wind of this, they will actually say, hold on, well, it was worth a couple of £1,000, so that's a pet as far as we're concerned. You've created a potentially exempt transfer. 7 years start to kick away now, and they will put the value of that painting in his estate for inheritance tax purposes, even though he gave it to her for £1. Makes no difference, that one. So that's an interesting one. So B is the correct answer there. That will potentially incur an IHT liability in the form of a pet. Interesting one, that one. You might have come across the phrase a grob. I love all these acronyms, don't you? A grob stands for gift with reservation of benefit. And what that means is that if you give something away to somebody, and maybe you give it at a proper price, she pays a couple of £1,000 for the painting, but Mr. Trent decides to have it hanging outside his front room 6 months in the year because he loves it so much. In effect, he's given it away, but he hasn't. He's actually reserved a benefit of using that asset. A gift with reservation of benefit doesn't even go into a 7-year rule. It automatically gets added to his estate on death because he's still using it. So that's an interesting point, that one, though. Okay, we're having fun here, aren't we? Got a couple more for you. So here we got Mrs. Richards. Now, Mrs. Richards, I think this is the last one for you. She wishes to leave her estate valued at £600,000 to her 3 children. How might she minimise the impact of the potential inheritance tax liability? Well, she could have done something during her life and created pets and stuff like that and weddings and stuff, but she didn't. So she's giving £600,000 to her 3 children in her will. And it doesn't matter what division she decides, her estate is liable for inheritance tax on £600,000, less the nil rate band, and then the remainder at 40%. So which of these ways then can we minimise the impact of the inheritance tax liability? Well, if she gives 600,000 to her children so that each receives 200 on her death, well, that doesn't make any difference at all. You're liable against the estate, not how much you give to the kids. By selling her assets to her children at a token price close to the time that she expects to die. That's just like that Turner painting example. That won't achieve anything. That'll create a pet, you know. But close to when she expects to die, so the 7-year rule, she won't live the 7 years, will she? C, by effecting an own life, whole of life policy written under trust with her estate as a beneficiary. Do we like that one? Let's see what else we got. By effecting an own life, whole of life policy written under trust with her children as beneficiaries. That's the better one. They're very similar. You know, own life, whole of life policy. Had that in the first question, didn't we? It's going to provide a sum assured, which will go to somebody who can then use that cash to pay the inheritance tax bill. Now, if you put the estate as beneficiary, that's a very difficult thing to do. Executor, you probably consider, but it's the children, ultimately, the beneficiaries, that have to pay the inheritance tax. So give it to them in trust. They receive it outside of the estate. They get it in cash a couple of days after death. They can use that cash to pay the IHT, release the money from the grant of probate people, and get the estate given to them. So that's the right answer, D. So there we have quite a lot of inheritance tax questions, which actually will serve you very well if you're doing the CeMAP 1 exam. Hope you found that useful. Bye.